Well, good evening, everybody. This is Steve Ribble with Shrink My Taxes, and I'd really appreciate you all taking the time to join us this evening to learn a little bit more about the trader tax status, and we'll jump into that in a second. I'd also like to thank Fari for hosting the event this evening. You're very generous, sir, and would like to thank Jeffrey Lynn and James Falba over at Market Heist for helping to organize this event as well. So a big thank you to all you fellows out there. Let's see. Jeffrey actually approached me this afternoon and wanted me to talk a little bit about the tax cut extension, and so I put a few things together, and I think, if I'm not mistaken, they're supposed to vote on this later this week. So this isn't set in stone as I see it, but what they're essentially going to be doing is extending the Bush tax cuts for an additional 2 years. So the income tax rates that are in place as of right now, which would be the top rate of 35%, is going to be extended out for another couple of years. Capital gains rate would stay at 15% for the max rate, and the AMT is going to be indexed for inflation. That's the alternative minimum tax. It's going to be indexed for inflation. Estate tax will be coming back next year, and the top rate there is 35% with a $5 million exemption, which I believe is what's on the table. And good news, I think, for everybody out there that draws a paycheck is going to be the payroll tax holiday. It's going to cut 2% off of that tax and put a little bit of money in everybody's pocket out there. Equates to, if somebody makes $100,000 a year, they'll see an extra $2,000 next year in their pockets. So that's always a welcome sign. I'm not sure, Jeffrey, there's any other additional questions beyond that, but from what I saw, that is what is kind of being formulated on the taxes as far as the extensions, and I think they vote on it later this week. Okay, so if anybody has any questions on that, you guys can type them in there. I'd be happy to grab those for you as well. So let's jump into trader tax status, which is what we're all here for this evening, and this is where we're going to be using the tax law to cut your tax bills. Start out with just a couple quick disclaimers and the lawyer speak, if you will. This is a presentation that's going to be for informational purposes only. It doesn't represent any specific tax advice, and I realize that everybody out there is unique, and they're going to have their own unique tax situation, so please consult with a qualified tax professional on any information that you might see here this evening. The second thing is that Hamzy Analytics and Market Heist, they don't assume any responsibility for any errors or inaccuracies or omissions in this webinar. They're just hosting the event, and they've been very gracious in doing that for me. And also realize that Hamzy Analytics and Market Heist don't provide tax advice, and none of this presentation should be construed that way as well. Okay. I'd like to start out with a quick quote, and Fari saw this today, and he made a comment, but it's William Rehnquist, who was a Chief Justice of the United States Supreme Court from 1986 to 2005, and I think this kind of sums it up. And he said there's nothing wrong with a strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. And I think that is what we can gather from this. Trader tax status isn't anything new. It's been on the books for quite a while, but understanding that code and using it to your advantage is where you're really going to get the benefit of cutting your tax bill every year. So the agenda today that I'm going to talk about is predominantly four things. It's going to be basics of the trader tax status and what the IRS looks for. We're going to look at the trader status benefits. So if you qualify for trader tax status, what kind of benefits are you going to see? And this is what I call WIIFM, or what's in it for me. We're going to talk briefly about entities for traders and some reasons why you may look at incorporating your trading business. And I'll finish it up with some of the frequently asked questions that I get in dealing with trader taxation. And if we have time, I think we're going to open it up for questions out there as well. So trader or investor, and Fari asked me earlier if this was a picture of me, and that gentleman there has way too much hair to be me. I'm not that fortunate, but if that is you, I apologize, anybody out there, because that was pulled off of Google Images. Are you a trader? Trader tax status, one of the problems that you'll find if you do any research on trader tax status is that the IRS doesn't offer a clear definition of what you would do to qualify as a trader. You can read their guidelines and their regulations, and it's really not defined in any specific specificity. And you'll see that here on the next slide of exactly what I'm talking about. I kind of equate it to, if you saw the movie The Pirates of the Caribbean, when they were talking about the pirate code, and the pirate's response was, it's more like guidelines. And that's really what you get from what the IRS gives you, and that's just general guidelines of what they're looking for. Most of what we know about trader tax status comes from court cases over the years. Cases like Mueller versus the United States back in 1983, where they really focused on holding periods and investment objectives. The Paoli case in 1991 focused on continuous trading throughout the year. The Frederick Mayer case in 1994 focused on actively managed accounts and deeming that as not really being actively engaged in trading if you turn your account over to a money manager. And then finally, the Steffler case was another important one, which focused in on the volume or the number of trades done throughout the year. I've actually posted those cases in more detail on my website, and I'll show you that a little bit later in the presentation. But it's always good to kind of review those cases because you can learn a lot about what other people and what they made mistakes on and how not to do that for your particular situation. So let's look at what the IRS says. IRS covers traders in securities in their topics 429, and I put the URL up there if you want to pull that off the internet and research it. But the gist of it is that they view a trader, or how they're going to view a trader, is you must seek to profit from daily market movements in the prices of securities and not from dividends, interest, or capital appreciation. In other words, you've got to be trading and not investing long-term and looking to accumulate dividends or interest or things like that. Your activity must be substantial, and you must carry on the activity with continuity and regularity. Okay, and I think you can see by that, that's exactly what they talk about, and it's kind of what I talked about. They're not very specific about what thresholds or what you have to do to hit trader status. So what do they look for? There's going to be 4 things that predominantly the IRS is going to look for to determine if you're a trader or if you're going to be classified and taxed as an investor. They look for typical holding periods of securities bought and sold. They look for the frequency and dollar amount of the trades during the year. They're going to look at the extent at which you pursue the activity to produce income for a livelihood and the amount of time that you devote daily to that activity. The key word there that I want everybody to take away is and, because if you miss one of those 4, you're going to end up getting taxed as an investor. And what that means for you on the tax side is that you're going to lose your home office deduction. Investors cannot deduct their home office. You're going to lose investment seminar deductions. Margin interest cannot exceed investment income. That's going to get carried from a Schedule C to your Schedule A and will be subject to the AGI, 2% AGI. You're going to be subject to the wash sale rule. And more importantly, in my opinion, is that you will not be able to use mark-to-market accounting or Section 475F accounting, which we'll talk about a little bit later in the presentation as well. So some big things there. You want to make sure that you're hitting all 4 of those points that I talked about. So let me give you some guidelines. Excuse me while I take a sip. General guidelines for traders, and I think if you're hitting a lot of these, you're going to be okay in qualifying for trader tax status. So to run through these, a substantial portion of your liquid net worth should be used in trading the market. You should have weekly buys and sells in your accounts. Daily is going to be even better. You should have a substantial number of buys and sells spread throughout the year. I mentioned the Paoli case earlier. 71% of his trades occurred in a 4-month period. He had 1 trade in October in the year in question, and he had no trades in November and December. And he lost his trader case, as you can see. They didn't view him as being in the business of trading because he didn't trade for a majority of the year. What do they consider substantial? Generally, north of 500 trades for the year, you're going to be safe in trader taxation. And if you're only doing about 1 to 200 range, that's going to be very tough to hold up your trader tax status. Typical holding periods under a month. Some of the other cases I mentioned previously, their holding periods were, in one case it was 8 years in some of the stocks that they sold and tried to claim trader tax status, and that isn't going to fly in the IRS's eyes. So you need to have weekly or daily is the best trades that you're doing in your accounts. You should spend a substantial amount of time watching and trading the markets, 3 hours a day minimum. And what I will tell you, and I think if you look at the Pioli case one more time, had he actually kept a trading log or had kept a time log, because he made the case that he was actually studying the markets and he just didn't trade on those days, but he had no documentation to back that up. So if you are spending, some time daily, reviewing charts and doing other things related to the markets, reading trading books, etc., that goes in your time log, and that can help substantiate your case for trader status. And you must maintain a business-like operation. You are qualifying in a trader status. You're going to be running a business as a trader, and so that means you need to keep good books and records and keep a trading journal. That's something that I know a lot of successful traders out there do, and that's just additional documentation to back up your case for the trader status. Now, how do you elect trader status? Well, the good news is that there actually isn't a formal election. You don't have to fill in any paperwork or do anything like that to elect trader status on your accounts for your tax forms. You can claim trader status for 2010, even if you haven't claimed it already. You can actually claim it for 2010, and you can actually go back and claim it for the past 3 years, which is years 2007 through 2009 on your tax forms. All that would be it would take is to file an amended tax return and include a Schedule C, which is a profit loss from a business, and put your expenses on that Schedule C, and then refile those tax forms, and you should get money back in most cases. So that is the good news. It's very easy to elect trader status. You can just go ahead and fill out that Schedule C. Not sure if you qualify, and if I'm not mistaken, I sent this PDF to Fari. He should have it up on the website later when this recording goes live. But you can go to my website at shrinkmytaxes.com and fill out the trader analysis and fax it or email it back to me, and I will review your case and let you know if you should qualify for trader tax status. I'll take a quick moment here just to pull up my website. It's going to be under this section right here, our services. You go down to trader taxation, and you'll see the trader evaluation questionnaire right there. Notice also I've got some sample deductions for traders, and the court cases I mentioned are going to be covered under there as well. But that's where you're going to find it off the website. Let's get back in. So WIIFM, what's in it for me? Why would somebody want to claim trader tax status? Two primary reasons is once you claim trader tax status, you actually are classified as a business, which means that Schedule C that I mentioned earlier. That means as a business, you actually entitled to more deductions. You're going to be deducting things on a pre-tax basis and not be subject to a lot of the restrictions if you were to be taxed as an investor. So that's a huge, huge difference right there. The second reason is going to be Section 475, or what's commonly known as mark-to-market accounting method for your trader business. That's going to be the second big one, and we'll talk about that here in just a second. So possible trader tax deductions. This list is on my website, and I think I showed you that there just a second ago, so you can actually download this off my website. But some possible deductions that you can look at are chat room subscriptions, such as Hamzy Analytics, HFT. You'll be able to deduct that off your income tax forms. Data feeds, such as DTN IQ, DTN Market Access, those are going to be deductible. Software subscriptions, so if you use Investor RT or Market Delta or some other different charting software that you're paying a subscription for, that's going to now be deductible. Newsletters, newspapers like the Wall Street Journal, Investment Business Daily, those are deductible. Trading books and publications such as Fari's terrific book, Master Traders, that's going to be deductible. Telephone, as long as you're maintaining a separate business line, even if it's coming into your home office, that's going to be deductible. Internet use, business use is going to be deductible. Seminars, including transportation and lodging costs, become deductible. That is something that isn't deductible if you're classified as an investor. And wages paid to family members. And this gets it back into entity formation and some of the ways that you can use an entity to your tax advantage. But if you're paying a spouse or a child, or if you've got a teenage son or daughter, you can actually pay them for data entry or trade reconciliation, things like that, and it helps reduce your actually helps reduce your tax burden and creates income for them. Rent is deductible if you're leasing office space. I mentioned before the home office deduction. That is something that is not deductible if you're taxed as an investor. Cable fees, for use with CNN, FNN, or CNBC are going to be deductible. Computers and office supplies, depreciation on all fixed assets, including that you're used in your trading, which you can take the Section 179 deductions on that. Margin interest, again, another key difference between investor-trader status is that it's if you're qualified as trader, you can deduct it dollar for dollar on that Schedule C, and you're not able to do that if you're classified as an investor. Legal fees, and then tax preparation and tax advice is also deductible. Mark-to-market accounting. This is a huge area right here that really, if you qualify for trader tax status, there isn't a reason why you should not elect mark-to-market accounting if you are trading securities such as stocks, options, and bonds. I'll talk a little bit later if you trade E-minis and Forex and why you may not want to elect mark-to-market with those types of products. But if you trade stocks, bonds, options, those types of products, ETFs, mark-to-market accounting, in my opinion, is going to be the way to go. Because if you are a short-term trader, all of that is taxed as ordinary income anyway, and so that you don't have any drawback or there's no disadvantage to electing mark-to-market. So let's talk a little bit about that. Mark-to-market is Section IRC 475. And what this does, in essence, is it's a change of an accounting method. And you're going to be converting capital gains and capital losses into ordinary gains and ordinary losses. And this is a huge deal. What would happen is at the end of the year, in essence, all of your open positions that you have on the last trading day in December are going to be priced as if they were sold on that day and then bought back on the first day, first trading day in January. So in other words, if you've got open positions that you haven't sold yet, they get classified as if they were sold and bought back, and any gains or losses are then realized on that year's tax return. It's going to be reported on Form 4797, which is a sale of business and property form. And the key thing here and why you would want to do this is ordinary losses can be deducted in full against any type of tax return income. Now what that means is, and I'll show an example here in a second, let's say that you're a full-time trader and you happen to have a spouse who does work and you have some losses for the year, then those losses can be used to offset your spouse's income on your tax return, which is great. It creates net operating losses, or NOLs as we call them, and those can be carried back up to 2 years for immediate tax refunds. If you file the amended returns there, and they can be carried forward if not used up by going backwards. You can actually carry them forward up to 20 years. So it's a huge advantage. So let's put these two side by side and see why you might want to elect mark-to-market. You can see on the left part of the screen you've got a trader using the cash method, or what I would call an investor. This is somebody who would just classified as an investor, or even a trader that qualifies for trader tax status that did not elect mark-to-market. And then on the right you've got a trader that did elect mark-to-market. You can see the gains and how they're different. That's actually the slide's wrong. I should take that back. The trader on the cash method, those gains are treated as capital income. Those are treated as capital income. So I apologize about that. That slide is wrong there. The gains, if you're under mark-to-market, are treated as ordinary income. Losses for a trader under the cash method, losses are limited to your trading gains, and then you can take an additional $3,000 capital loss on your taxes. Losses with mark-to-market, they're taken in full. You're taking an ordinary loss. Losses under the cash method cannot be carried back, whereas you can see under mark-to-market you can carry back a loss up to 2 years. And under the cash method, losses can be carried forward until they're used up, whereas under mark-to-market you've got 20 years to use up those losses. So putting some numbers to this just to kind of get a feel for this. Let's say that you had two traders, one using cash method, one using mark-to-market, and they both encountered a $20,000 trading loss. Both of them had spouses who worked and had $100,000 of taxable income. And you can see with the cash method, you're only able to deduct that $3,000 capital loss, and that makes their AGI, their adjusted gross income, now $97,000. Whereas that entire $20,000 trading loss then gets taken off of the mark-to-market accounting, gets taken off their income, and their AGI is now $80,000. So that's a huge benefit for those traders out there. So the mark-to-market, what I can tell you about this is that if you make a mistake or you file late, you can lose out on this benefit. There's 3 steps, 3 important things that you need to do to elect mark-to-market. First of all is to attach an election to a prior year tax return or extension. Let's say you're going to elect mark-to-market for 2010 or for the 2010 tax year, which would be next year's taxes. You would make this election, attach that statement to your taxes before April 15th of next year, and send that in with your tax form. And then you're making the election to file as mark-to-market.